Friday morning, Market Chameleons, everyone. Joining Market Chameleon for the first time. Thanks for coming in. And there he is, all the way from sunny South Jersey, Dimitri Pargamanik. Happy Friday, D.
Good morning, Will. Happy Friday.
Awesome. Do you see the disclaimer up there for everyone to see?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's a disclaimer.
Excellent. So what's on tap for this morning, my friend?
So what I'm going to do is try to cover some of the questions we got yesterday towards the end of the show. They're good questions. One, I think, was from Robert. One was from, was it Mike?
I think it was Michael, yeah.
Yeah, so they gave two good questions. I'm going to try to see if I could cover both of them. I think Mike was asking about the calendar spread and how does the payout of the diagram look like, maybe like a risk profile. The other one, Robert asked about, does the implied volatility of the market tend to change during earnings season? So I think it's more like a seasonality, implied volatility, a seasonality question regarding implied volatility of the market. So let me try to see if I don't get both of them today. I'll do one today, one on Monday. And I'll start out with the seasonality question. So maybe I'll do that one first. If I have time, I'll go to the next one as well. And if you guys are joining us for the first time and have questions along the way, you can put those in the live chat on YouTube. Will's watching it, he'll read them back to me. If you do want to come on a show live and ask a question, we also put out a link to Zoom. If you click that link, it'll take you over to Zoom. Once you get to Zoom, there's a button, raise your hand. If you click on that, you don't have to turn on your video camera, but we'll be able to hear you live. You could ask your question directly. So let's start out. We'll take a look at the pre-market report, see what's trading in pre-market hours. And then I'm going to go to SPY, use that as an example, and we'll take a look at how the implied volatility tends to move around based on calendar year. Does that sound good, Will?
Yeah, perfect.
Okay, so let's start out pre-market report. These are stocks trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. And here I'm coming down here, I see 93 stocks made our percentage gainers list, 62 on a percentage decliners. So right now, from that perspective, looks like a more bullish bias at the open. I'm going to filter down this list to just S&P 500 stocks to see what's going on there. This will take out ETFs, closed-end funds, preferred stocks, rights, all these other stocks. We're going to take them out just to focus on stocks that are part of the S&P 500. To do that, I'm going to use the filters above. So here's a drop down. In ETF, I could select any of these ETFs. When I select the ETF, this report will get filtered by the holdings in that ETF. So SPY is the S&P 500 ETF. Now this list got filtered down by holdings or constituents of SPY. And here we see 3 stocks made our percentage gainers list, 1 on the decliners. So not a big list. It's not maybe still a little bit more favorable towards the bullish side, but not a lot going on. Just that ILMN down 15%. That looks like it's reacting to news. So here you could see when there's these, a little E indicates that there's an earnings release either yesterday after the market closed or today before the market opens, and that's a reaction to that earnings release. So if we have no questions, Will, up to now, I'm going to move on to seasonality.
Yep, you can move on.
Okay. So, and I think that was the question. If Robert's there, if I'm going along the way, if I'm on the wrong path, let me know. But I believe that, the way I understood it was in regards to how implied volatility tends to move in the market itself.
Yeah, he was looking at SP. I think he was talking about SPY. Yeah.
Okay.
So, Rob's on. Rob, if you, as D goes through this, if you have any questions, is this helpful to what you were asking about yesterday? Let us know.
Yeah. And just to set up here, I'm going to start out seasonality and stock price. And before we get to the implied volatility, which are, that's related to options, let's see how the stock tended to do, or the market tended to do on a seasonal basis. And here, this is SPY. This is a 10-year seasonality look back, right? So the last 10 years, you can see here, these are the years, and this is the calendar month. And for each year, it tracks how did SPY perform for that calendar month. And here we have the summary statistics. So we just came out of July. So you can see here, July was a big up move in SPY, up 9.2% in July. Right now, we're still in August, haven't ended there, up 1.9%. And here we see that July actually, out of all the calendar months in the last 10 years, was the strongest month, right? So in the last 10 years, 90% of the period, 90% of the observations, SPY, and did higher at the end of July than from where it started. And on average, gained 3.2%. So if we just look at the best performing months, this is the median return, 2.4%. So you could see here that even without the average, the median, which is the return rate in the middle, is up 2.4%. The highest, best return in the last 10 years was 9.2%. It was this July. Lowest was negative 1.3. So how does August compare to July? So we see here it still tended to be a bullish month, 72%, almost 73% of the last 10 years, the stock was higher for an average gain of 1%. So you could see here, we're up 1.9% already. And if we look at just the average move up or down, that's the absolute move, it's about 3%. So these are things that maybe we could look at and say, okay, maybe bullish, but where may we fizzle out to the upside, right? So we already have a 9.2% gain here. We're adding about 2% already on top of that last month. And, a couple things though we can look is that we did have some bad months here. So some pretty big down moves, we're recovering. But where do we think that on its own, lacking any type of catalyst, were may fizzle out? Maybe, here's an average move, 3%, so maybe that's kind of how you could potentially start looking at it as a distribution of returns. But September, to me, looks like that's where the weakest month is, right? So that historically, the weakest month is the month of September. So, we're watching here August. We'll see how September does, but that just from the SPY perspective, not implied volatility, but SPY tended to be the weakest month of September. So then the question is, what about implied volatility? How does the implied volatility tend to behave during the calendar months? Are there certain months of the year, right? Like certain months of the year that implied volatility is higher, certain months of the year implied volatility is lower, are maybe the months where we have earnings, does it go up? Does it tend to come down? So I think that's kind of like the question we want to look up. So to do that, I'm going to come here to the volatility section. And under volatility, we're going to take a look at seasonality. Okay. So this is kind of the same thing, but it's looking at the seasonality of the implied volatility, and we could graph it against the historical volatility as well. By historical volatility, what I mean is we could compare for the month, how did the implied volatility tend to behave versus how did the actual volatility of the stock tend to behave. Okay, so we can do that from here using this graph. But here we see that the implied volatility, was up here in March, tended to come down, and then we do get a couple, you could see here, a couple times it, moves up, comes back down, moves up, comes back down. So that could be partially, due to the earnings and other factors. Let's take a look here below, and this gives us a table of how the implied volatility, right? So this is the average implied volatility per calendar month. So here we could see, where the average implied volatility is per calendar month for SPY. So March was a high one, median is 13.6. So the difference between average and median is the average can get skewed by very big moves. Like over here in 2020, we see where the coronavirus hit, implied volatility went way up, right? And that's unusual. That doesn't happen every year. So the average will get skewed higher from some of these big outlier moves. So the median return kind of smooths that out. So if we take a look at the median return, we see it actually looks to me like month of February and January. January and February tended to be very high implied volatility months. Right now we're in August, so we're looking at 12. September, usually similar, starts ticking up October, November, December. All right. Let's take a look at another perspective of the implied volatility. I'm going to come down. Let's come down here. And this here is looking at how the implied volatility tended to move within the month. Okay, so to read this, let's see, we're in August right now. So here we see that the start of August, okay, on the start of August, implied volatility on average was 12.8. Okay, that's where in the last, 10 years we're looking back here, was 12.8. On average, from 12.8 to the high point of the month, we went from 12.8 to 17.7. From the start to the low of the month, 11.2. So we could see here that from the start of the month, the move to the upside was much greater than the move to the downside. That's how it tended to move. And then from the start of August to the end of August, right, from the start to the end, we could see that moved from 12.8 and tended to finish higher, 13.7. So those are the averages, but I'm just looking down below and I see that the median is a little bit different. So the median, the start was 12.8, but it finished lower, 10.9. So remember the difference in the median was that the average, any kind of big outlier, right, will skew the whole thing up higher. So the median return is kind of like those right in the middle.
Hey, D?
Yeah.
Rob asked, January is the start of earnings. So is the higher amount applicable to other earnings months?
Well, yeah, right. Here you could see, right, all the months, right? So if you say January is which one would be the next one? January, February, March, is it April? then
Yes.
made right. So you could see here how it tended to move. You know, this is showing start of month to end of month, right? So and you get a sense of the high and low intra-month.
Hey, Dave.
These are, yeah.
I hate to interrupt you, but could you just go back to the clicks that led you to this actual page for SPY?
Yeah. So for here, this is the implied volatility for SPY. So under the volatility section on the left-hand side, if you click on that, it's seasonality, and that's where I'm at right now. So under volatility, seasonality.
Perfect.
There's a different seasonality here, and that's looking at the seasonality of the stock price or the performance of the actual underlying. This is looking at the options. Okay, so, and we could overlay this with, I'm going to take this out. I'm going to take out the option volume for a second. Let me take out this. And this is how the historical. So this is how this red line, that's what the actual volatility was versus the implied. Right. So you could, so remember, implied volatility, that's coming from the options. The historical volatility, that's coming from the actual stock. Okay, let me come down here. So if you guys are okay with this chart, okay, so this is the median. The other thing it breaks down is the high and low. So here we see July, I'm sorry, we're right now in August, right? So we're right now in August, and this is showing us the highest and lowest volatility to compare the highest volatility it started out and the lowest. So we could see here 19.3 is the highest implied volatility so far out of, you know, the last, whatever, I think we're going back to 2014, which is right now, right? Right now, actually, I'm sorry, that's over here in 2020. So we're really close to that, right? To 2020 as far as implied vol goes. And we could see here that it went from 19.3 to the high intra-month 33.6. Okay. 33.6 and to the low 17.2. Okay, so and here it finished 23. Okay, so that's looking at the highest, right? The highest low, the highest finish, the highest high, and the highest open. Okay, the lowest start in August was here, 2017, 7.4. Let me see, it finished at 7.7. Right. When it started at the high, 19.3, it finished lower, 18.7. So this kind of gives you a sense and distribution of how the implied volatilities behaved historically in the calendar month of August. All right. And if we wanted to take a look at what we think, you know, where we may finish up, you know, are we going to finish lower or higher? The median tells us, you know, if we compare the median, it tells us a little bit lower. So down here, we have two more charts. I'm going to start out with, let's see if I have time. So I don't know if I'm going to have time to go to the calendar spread, or I could do the calendar spread and come back to this, or should I just stay on this one?
Yeah, I would just stay on this. Rob actually is super thankful. He says it's another tool I had no idea was available.
Yeah,
looks great.
So it gives you, yeah, and I'm on SPY, so you could do this for any stock, right? So you could go to Apple, whatever, do the same type of
analysis. Yeah, that's great.
So here, there's two tabs here. Okay, the first one is it compares the average implied volatility for the month versus the actual realized volatility. So what it does is it say, okay, implied volatility is changing throughout the month, day to day. Realized volatility is also moving around. So if we compared just, took the average of the daily implied vols versus the actual volatility, how did the month of January's implied volatility compare to the actual volatility of the stock? So we could see here, that on average in 2022, implied volatility was around 18.9. However, the realized volatility in January, the stock moved at a much higher volatility, 26.6. So you could see that the implied vol was at a 30% discount on average. While, here it was the reverse. The average implied volatility was 19.5, but the realized volatility ended up being 15.9. So that was at a premium. But if we look at all these, right, we could see that over the course of these years, 2014 to 2022, if we compare the implied volatility to the realized volatility, implied volatility underestimated the move, right? 3%. So you could see that the average of all the IVs versus the realized, the implied volatility was below. If we compare the median to the median realized vol, it's also a little bit below. Okay, so that's what this is doing, is comparing now not just the seasonality, but how the implied volatility levels were in relation to the actual vols. So let's go, for example, in the month of August. So we can see here, August implied volatility tended to overestimate the realized moves, right? So that's what this is saying. Implied vols were higher than the realized vols. That's the premium. And then we could go forward and look at that here as well, right? Right now we're in August, sorry, we're over here. So implied vols tended to be higher than the realized on average. But what about the start, right? What if you just started out the month and use that as your benchmark? Where did the implied volatility start? If you did it that day, for the rest of the month, how did the stock do? So that's start of the implied volatility versus realized. So it's not taking the average of each day within the month. It's just looking at where did it start out, and how did the stock actually do, right? So here we see that it tended to start out January 14.2, but the realized volatility was 16.3 for that entire month. So the start of the month in January, it tended to underestimate the volatility. Does that make sense to everybody? So if we just took one day and said, I'm going to do a straddle just on January 1st, and then that's all I'm going to do and trade the volatility of the stock against it. On average, you could see that straddle tended to underprice the actual volatility. Okay, and that's how you could read these going forward. So that's based on analysis based on calendar month. All right, so here we are in August right now. In August, so it was close. Historically the start of the month tended to be pretty good at predicting the actual volatility for the month of August, right? So that's pretty, over here, that's pretty close. Here, that's pretty close. This is September. So really where I see bigger deviations is maybe July, May, down here. Okay. Well, I don't think I'm going to have time then to get to that calendar spread today because I have
we'll leave that for Monday. Wait,
Leave it
actually,
for Monday.
question. Chuck asked a question. Chuck's
Okay.
Thanks for pointing out that, Rob. I missed it. Chuck asks, interesting, but I suppose that options lag behind the actual stock fall.
Options will lag.
I guess the option vol lags behind the stock fall. I think that's what Chuck is
Well,
saying.
it's usually the options are trying to predict the future vol, right? So they're trying to actually.
Well,
they're trying to be a leading indicator, right? So when you think about implied volatility is kind of an indicator of the market's perception of future volatility. So that's
what's going on every day, right? I mean, there's at every month strike. I mean, those are the real time. People are putting capital use, making
as they're responding to information, they're trying to predict what the volatility will be going forward. So like over here, when I say start IV, so in the month, January, the options were trying to project what the volatility will be, for the rest of the month. And then we could look back and say, well, what did the actual volatility do? And what was how, from the start of the month, how did that prediction work out? Now they are moving, so they're reacting, right? So even though they start out, they're starting to react to new news and information. But if we just took one point in time and said, here's the start of month, what is the initial prediction and how did it end up? But you're right, where it is it's continuously trading and continuously reacting to new information. Just like a stock price, right? Stock price is trying to forecast future earnings and future profits and future sales. So all that is embedded within the stock price, but it's continuously updating as new information comes in and those models are changing and new people, are coming in.
Great stuff, D.
All right.
Mike just mentioned thumbs up. We always do appreciate the thumbs up. Obviously, hit the subscribe button, click the thumb. We literally never say that, but thanks for pointing that out, Mike. Everyone have a great weekend. Great job, D. Great question, Rob. Thanks so much.
Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys on Monday.
Have a great trading day. Great job, D. We'll see everyone on Monday. Bye-bye.
Thanks, everyone.